So I'm sure it hasn't escaped anybody's notice that today's headlines are filled yet again with stories that go to the heart of ethics in society. And the allegations on FIFA really just bring back to the surface a lot of what we've talked about over the last 2-3 years, which is about how we get ethical behaviour, responsible conduct that society expects working in financial services. So, well, news consumption and these stories come and go, and every day we see a new story, a new illustration of where individuals have fallen short of the expectations. The theme that runs through, and the theme that I'm going to talk about today, is what it is we have to do to get ethical behaviour, reasonable conduct, the sort of behaviour that society expects, to be something that we expect to exist in financial services and in all walks of life. We saw last week's global FX fines. You saw the figures, they're large sums of money. The debate around trust and confidence in banking in particular has not been diminished in any sense by these stories which continually come out. And so for leaders today, a more challenging priority probably than it's ever been, certainly more than in 2008 when we were worrying about the existential threat to institutions, is about the credibility and how well we can talk about the lessons learned, and particular how we can talk about the lessons learned as to what we expect in terms of ethics and conduct. So the experience of this sector has not been one where time is the great healer. It appears to be getting worse. And the similarities that we see in some of the high-profile cases like the FX manipulation, LIBOR, other cases like the sale of interest rate hedging products, PPI, which no doubt all of you have received some text at some time saying you may be owed money, all of these have polarised this debate. So on the one hand, you've got frankly, those today who appear reluctant to admit to wider industry challenges around misconduct. So it's dismissed as a few bad apples, and every town, every part of society will have a few people who disobey the rules. And on the other hand, you've got those people who see the repetition as proof that this is a sector that is not engaged with change, that the cycle of misconduct resembling a Mobius loop or Groundhog Day, where we appear to continually return to the same starting point. Now, both sides, those who think it's a few bad apples, those who think it's endemic and systemic in the industry, will point to evidence that affirms their own worldview. But the truth is there is a serious debate around trust and confidence in banking, and that debate is a resilient one, in part because it defies easy analysis. It's not an easy problem to address. We've got well-documented challenges to contend with, and I want to look at some of those this morning, but it also has, and I think we've got some credible reasons for optimism in terms of where we stand today. So most important perhaps, and the story I deliver certainly to bankers, to the industry, is that there is an obvious commercial imperative for industry leaders to address cultural issues. And as Philip says, one of the issues in society today, in an ageing society particularly, is that we do need people who trust financial services, because our expectation is that all of us will be living a significantly longer period post-retirement than our predecessors, and all of us will have to provide for that in a more private way than we did in the past. So we have to trust financial services. Therefore, financial services has to be able to show itself capable of being trusted. There's an important question, which is, if reputation is so important to firms, why is it that cases like FX, like LIBOR, like PPI, they seem to emerge and then re-emerge with such regularity? And for banks, there are clearly some significant complicating factors here around areas like competition, transparency, incentives, and the like, each one demanding some level of explanation, some level of resolution. But for me, I think there are two decisive issues that require moving forward if there's to be any prospect of definitively resolving the trust and confidence debate. First, the accountability agenda. This is the agenda around governance and structure, areas highlighted in last year's Virtuous Banking report. And second, individual accountability, and in particular, the crucial and many senses often overlooked problem of the importance of middle management in driving cultural change. So let me first reflect on the first point, structure and governance. There's no doubt at all, and you've heard the speeches from chairs, CEOs, non-executive directors, that the ambition of bank leaders to reform culture is not in doubt. We have heard it time and time again, how the situation needs to change. No CEO enjoys explaining away yet another conduct case to investors and the customers, nor the penalties that follow it, and the penalties have got larger over time. It's hard to think of a topic that is invested with more corporate energy in terms of relationship with the media, with press. Boards tell me they spend up to 80% of their time discussing regulatory issues, not just capital and leverage and liquidity, but increasingly the conduct agenda and fines and risks. So it's not a challenge of intention, it's a challenge of execution and the complexity of execution. So put simply, it's not a straightforward one to govern the behaviour of individuals at large, heavily stratified banking institutions, many occupying a significant place in this society, but operating over 40 or 50 countries with 100, 150,000 staff. It's a complex body to drive culture change through. Simply sending your staff on a 2-day sheep dip on culture change doesn't do it. I was struck by a conversation I had with a CEO, not in the financial services industry, but in the airlines industry a couple of years ago, who told me that cultural change takes time. And he started to say it takes 18 months. And I was about to cut into him because I was going to say, well, hang on a minute, 18 months isn't long. But he continued, it takes 18 months per level of management. So this is not a 1 to 2 year phenomenon, 18 months per level of management. And you'd have heard the CEO of Barclays, Anthony Jenkins, talking on the radio a year or so ago, talking about this is a 5 to 10 year journey. So it's not simple and it's not quick. The other linked governance challenge in establishing long-run change is that there are almost by definition significant philosophical complexities involved in setting risk appetites for something called misconduct. We've got an industry that has evolved to express its appetite for things that go wrong in terms of risk appetite. So the conundrum here for leaders in our industry is how you express that for so-called soft risks, behaviours, choices, values. How do you set controls and ratios that can be governed by mathematical models? It's difficult, for example, to come up with a value at risk figure that satisfactorily states an appetite for conduct failure in the same way that you would for, say, the value at risk of your overall portfolio. So bank boards are very familiar to go home at night knowing that somebody has told them with confidence that our risk appetite is that we'll lose no more than £100 million, say, on our total portfolio based on a 3 standard deviation movement of whatever the relevant asset classes are. And that's the sort of expression of risk appetite that has become very familiar and embedded within all financial institutions. Now, I don't know how you convert that into a risk appetite for what we call conduct risk. Do you say, well, actually, as long as no more than 2 of my traders are manipulating global benchmarks, that's okay? Or that we only are mis-selling £10 million worth of product in this month? Maybe you say that we're only front-running 5 of our major constituents or institutional clients. So it's ridiculous, it just doesn't work. And so the idea of coming up with an ex-ante expression of conduct risk is a misnomer. And in a sense, the industry, the lingua franca of our industry is numbers, it's ratios, it's percentages. It doesn't translate into the things that we're now talking about, which are about ethical values. There's a pressure on boards and executive committees to base strategy on scientific measures of business risk. It doesn't work here. That's the key point. In seeking definitive measurable conclusions, there's a danger that analysis replaces judgment rather than supports it. You can count whether all of your staff have gone on the training course. You can count the number of your senior management that can complete a questionnaire that asks them to make judgments about different types of complex situations. They're all inputs. They don't actually tell you is the output that we've got a more ethical decision-making structure in the organisation. no one, by way of example, was talking pre-2007 about chains of accountability, even post-Leeson. It wasn't something that became part of the language of organisations, of financial institutions. Yet as the crisis unwound and we moved through a cycle of misconduct cases, all without anyone apparently being held responsible, it quickly became one of the most significant conduct risks facing firms. So as we move forward, it's imperative for leaders, policymakers, the industry, to not just ask if something is doable or whether there's a measurable risk, but to interpret the principle behind it, the ethical principle that sits behind it. And this certainly applies to the core debate around accountability, where the industry has found itself confronting some very challenging questions, most important and difficult of which was probably the following. How was it possible to justify an environment where rewards were heavily individualized, yet responsibility for mistakes was mutualized? Profit was privatized, losses were falling on the public sector. So protection, if you will, on the basis of the murder on the Orient Express defense. It could have been anybody, it wasn't me. And that's where personal refuge was sought in numbers, and that's what we've faced significantly when we look at firms and when we look at accountability in firms. We've had the experience, actually not once, but a few times, of where we've had clearly an incident occur, a rogue trader, if you like, within a firm, and we've gone to the firm and said, well, can we talk to the manager? And we sort of got a delay and then a further delay, and then they came back and they said, well, actually, we're not sure who that is. And we said, well, that seems a bit odd. Surely you must have an accountable structure. And so please show us your organisational chart, show us your structure. And we went through a process. And we did the work of saying, well, actually, we've identified at least these 4 people who we think could have been the responsible manager. And so those 4 people came to us armed with a battery of lawyers and compliance staff to give us convincing reasons why they were not the manager of the individual concerned. So one of the questions will be about personal accountability, about responsibility. Even Victorian banking, with requirements on staff to put up surety as a condition of employment and the like, had an arguably more nuanced understanding of personal accountability. So perhaps inevitably what's followed after a fairly intense period of political and societal scrutiny is more focus on the individual, more focus on accountability. The Parliamentary Commission on Banking Standards published its report on professional standards and culture 2 years ago. ResPublica, as we know, published its research paper in 2014. And in March this year, the FCA and the PRA published their feedback statements on a number of core accountability-related issues. One of the most important of these, certainly in terms of the debate around governance, structure, stratification, opacity and the like, has been the development of a requirement for firms to construct so-called responsibility maps. Organograms setting out the allocation of responsibilities across individuals, governance arrangements and the like. And these in turn are supported by the arrival of statements of responsibility, establishing in some detail the individual areas that each senior leader will be accountable for across 17 management functions. So we want to get away from the answer that says, actually, we don't know who's responsible. We can't quite point to it. It was a committee, or we're not sure, to something that says, OK, there's the map of responsibility. There are the individual responsibilities. So this will cover executive directors, significant responsibilities with senior managers, money laundering reporting officers, compliance oversight, heads of internal audit. And critically, it does away with the current emphasis on influence, the significant influence function, which has been such a core part of today's regime. Influence itself is a difficult concept to objectively define, ambivalent enough to provoke legal uncertainty, and it brings us towards a system where responsibility becomes clearer and more immediate. Importantly, it also moves us away from a position where determining who is accountable for what within organisations can be an enormous undertaking. So while regulators today can collect and enrich literally billions of data points to detect sophisticated algorithmic market abuses, establishing the most basic line management relationships have in the past proved hugely optimistic in the face of corporate filibustering. Now, the other key area here, of course, will be the new presumption of responsibility, which lies at the centre of this industry debate around high standards of accountability and how they ultimately change the city. The core ambition, effectively, is to make sure that where a firm contravenes a regulatory requirement in an area for which a senior manager is responsible, it's up to that manager to justify, to satisfy to regulators that they took reasonable steps to prevent that contravention happening. That differs to the system that exists today, where it's for the regulator to establish what steps the senior manager took, which steps weren't taken, and whether they were reasonable in the circumstances. So the broad political intention here is to rebalance responsibilities and avoid a now familiar scenario where it becomes very difficult for regulators to definitively demonstrate whether X or Y individual was first of all responsible for the particular area, and then secondly took reasonable steps to prevent their firm breaching whatever regulatory requirement in their business area, so the area for which they're responsible. Now, this opens up quite a lot of important questions, quite a lot of important philosophical questions, and the challenge put back to regulators, to us, has been, will you apply this presumption proportionately and fairly? And that's a reasonable question. And what actually are the steps that a senior manager has to take to rebut the presumption? Now, you can imagine the lawyers would, and I'm sure there are one or two lawyers in the room, the slightly unsatisfactory answer here, but if I'm really honest, the honest one, is that it's very difficult for policymakers, for us in advance, to be prescriptive about the steps that a particular individual is expected to take. And as Philip explained earlier, simply coming up with lots and lots of rules, you will create an industry where people say, okay, you set down the 10 steps that were required, I met those 10 steps. The fact that I failed, or that my business area failed, can't be held against me because I clearly met the steps that you had set out. So we're not going to do that. It would be ridiculous to do that. We can't possibly make that judgment ex ante as to what all of the steps are at a prescriptive level that an individual should take in delivering or discharging their responsibilities. But actually, the steps that senior managers, we would expect them to take, are actually common sense, frankly. The things like behave with integrity. That's something I hope is understandable. Delegate appropriately. Make sure that you understand your business area. Comply with common law. Comply with existing rules and regulations. But it bears repeating here that given the scale of misplaced alarm, that neither the senior management regime nor the presumption of responsibility corresponds to a heads-on stick approach from the regulator. That's not our starting position. Indeed, as is the case now, and as we are required to do, the FCA will apply the presumption proportionately and in a way that's fair to the subject, to the firm, to the individual under investigation at any time. So in other words, there's no sense in which there's a prospect of an institutional scalp hunting process. It's not a matter of public theatre. Quite contrary, in fact, the expectation is that heightened accountability reduces the need for individual pursuit by regulators. So that's the whole point. If individuals feel that they have a greater level of accountability, they'll take more steps to make sure that we don't have to come looking for problems. Now, time will tell just how significant that reduction in risk derives from that. But for boards and executive committees, the clear upside here is that a functioning accountability regime offers the prospect of employees becoming less prone to regulatory transgressions. And that brings me on to the point I started to talk about earlier, was the really critical but somewhat underplayed importance of middle management in restoring trust and confidence. So middle management, once you get 3 steps removed from the CEO, when you're talking about regional managers who maybe aren't so close to head office, you're talking about product heads or particular functional heads, this is where, in many respects, they have the greatest ability to affect the culture of the firm and the outcome for consumers. So while we've quite rightly and properly seen the significant attention focused on the most senior leaders, there's probably been a little too little debate around the many thousands of decision makers that sit below those senior leaders. In part, no doubt, that's a reflection of the importance that modern businesses attaches to the top of organisations. So Vanguard founder John Bogle famously talked about successful managers being paraded like Hollywood stars. It's an imperative, however, that leadership responsibility at the top isn't taken to imply a lack of responsibility for change in the middle. Bank boards, frankly, are no more able to reform cultures on their own than star riders are able to win the cycling tour without a team of masseurs and domestiques and the entire apparatus that goes with propelling the star to the front of the Tour de France or the Giro d'Italia, to take a more current example. So you could answer that those at the centre of organisational pyramids should, by basic laws of average, influence greater numbers of colleagues on a personal day-to-day basis than a clutch of senior leaders. So that's why the focus has to be on those as well as the senior leaders. So the core question for us and for policymakers generally is whether the influence tends to be positive or negative. And frankly, that partly depends on how you frame the question. And it will depend partly on the cultural journey that different organisations have gone through. So I don't think middle managers in banking are fundamentally different from any other industry. As individuals, I'm sure they're not. Certainly not in a pejorative sense. By and large, people do, I think, want to do the right thing. But if you ask whether the environment they operate within creates a greater test of moral resolve, I think the answer is probably yes. And that greater sense of moral resolve partly comes from the very direct influence to the P&L that sales have. And it's different to other industries. It's different to manufacturing industries. Sales clearly are important, but product quality is absolutely important as well. If you ask whether the environment is tougher, I think the answer is yes. One recent study, a European study of culture in banking, explicitly noted the capacity, as it put it, of the industry to weaken the honesty norm in its workforce. And middle management is called the so-called permafrost in the organisation. It has to be seen as a key engine for change here, and a key engine if we're going to drive through some of the changes that I know we're talking about here today and ResPublica has published. And it's no coincidence that even as leaders are explicitly talking up the value of cultural change, more than half of their financial service executives, presumably informed by these immediately above and around them, told the Economist Intelligence Unit that ethical flexibility remains important to career progression. It's not a job of regulators to mandate how firms manage what are effectively business issues, nor is there any desire in the city for policymakers to become the conscience of capitalism. But there's clearly a responsibility to support the creation of an environment that can reduce the incentive for misconduct, so create the honesty norm, if you like. And this is essentially where the new certification regime comes in. So whilst the current approved person regime captures individuals at the top of the organisation, as well as those in some critical customer-facing roles, there's a blind spot here, and that blind spot is in middle management. And what are often material risk takers in the firm may not be subject to our regulatory fit and proper standards. So for leaders, this becomes a problem because accountability structures begin to resemble safety nets with significant holes in them. You might have junior advisory staff in banks approved, so customer-facing roles, but senior commodity traders not approved. That's under today's model. The certification regime will help address that, placing a much clearer expectation on firms to uphold standards of fitness and propriety of anyone in a so-called significant harm function. And this brings me on to the final point I want to make this morning, the new set of conduct rules, which now capture all individuals involved in financial service activity in banks and in turn sit alongside both the senior managers and the certified persons regime. So what we have here then are a very high level, and they are very high level, but a significant suite of requirements that apply to a far larger percentage of employees than we've ever encountered before. Indeed, the only individuals, frankly, who aren't going to be covered are ancillary staff, reception staff, security, cleaners and the like. For those to whom the conduct rules do apply, the new requirements are very simple, a very short set, and they require employees to act with integrity, to show professionalism, pay regard to the interests of consumers, treat them fairly, and being open and cooperative with the regulators. And that's about it, actually. It's not much more complex than that. It's not, I think, an impossible benchmark for people to wish to attain. The expectation is that in the vast majority of cases where staff ignore those rules and don't live up to those standards, it's actually down to the firm to deal with it and to take whatever corrective action themselves, albeit within a framework that does allow the FCA to take action if it sees that it needs to. So what we have in effect are principles that provide I think a clear baseline for staff, a clear baseline for management, and should support key areas like performance management, career progression and the like, giving staff greater confidence to challenge colleagues if basic principles are abused, and importantly for us, driving that set of ethical considerations, culture considerations, right through the middle management of large, complex firms. So let me conclude, and for the purpose of today's debate, there's no doubt that this collection of policy work, from statements of responsibility to certification and conduct rules, represents one of the most significant post-crisis reforms for financial leaders. Much of the early part of the response to the crisis focused quite rightly on balance sheets, on capital, liquidity, on leverage. What we're now focusing on is the ethical soul, if you like, of financial institutions. It'll be critical as a means of addressing that core challenge that we started with, is how do we rebuild confidence in financial services. It'll reduce incentives for misconduct, it will increase personal accountability, and hopefully you have, as I've said, the basis for rebuilding trust. And that surely is what it's all about. That's where we want to get to. We want to get to a situation where bank boards are not spending 80% of their time worrying about conduct risks or worrying about what the regulator will worry about. What we want is financial institutions, banks that get back to doing what we need them to do, which is service the real economy. Thank you very much.